the third takeaway she talks about is anyone who's getting closer to retirement, it is time to think about de-risking your portfolio. I 100% agree, but you have to do it in a way that makes sense for you. Oftentimes, we'll see these target date funds that just automatically adjust your equity to bond ratio based on your age. Well, the question I would ask there is, do you have the exact same financial goals and the exact same risk tolerance as everyone else your age? Probably not. So, should your investments reflect to be the exact same as everyone else your age? Probably not, right? So, it's important to understand that your financial plan should be built on your financial situation and your financial goals, not other people around you and what your age is. It's more about your life situation. And understand that it can actually increase your risk if you don't own enough equities. Good morning, everyone. It is Thursday, January 16th, 2025. Hope everyone's having a great day. And today's retirement planning coffee talk, I hope to answer as many valuable questions as I can for you. With that being said, weekly retirement planning coffee talks are a casual way for me to connect and answer questions, even if you are not a client, at no cost. Join us on Facebook Live here, or stop by my office to enjoy free coffee. The door is closed to minimize noise, but just knock and come on in if you'd like to stop by any Thursday at 10 a.m. as long as I'm doing these coffee talks, or stop by any other time. And if I'm not in a meeting, I'd be happy to sit down and have a conversation with you. If you'd rather not ask questions online or in person during the live session, feel free to message me directly or simply enjoy your coffee at my office and we can chat once the live video wraps up. There's no pressure to work with me or become a client, whether you join in person or online. My goal is to provide as much free value as possible to as many good humans as I possibly can. My mission is to provide my clients with the highest quality advice and service possible. To maintain this level of care, I limit my practice to 100 active clients at a time, as I have a fiduciary responsibility to each and every one of them. While I cap the number of clients I work with, I am dedicated to serving as many people as possible by sharing valuable information and answering your questions. That's why these coffee talks mean so much to me. I'm looking forward to some great conversations and hope you have a wonderful day either way. Please feel free to comment with questions anytime now or during this conversation, this live video. I'd much rather answer your questions than read through articles that may or may not be relevant to you. With that being said, I do have a link included in case you would like to schedule a 15-minute phone call with me to have a more private conversation. If you feel more comfortable having private conversations than a live conversation where other people are involved, I completely respect that, and I will include the link. It's in the description, as well as I will put it in the comments section. Disclaimer: this content is not legal, tax, or investment advice. Always consult a qualified professional regarding your personal situation, and since this is a live session, I may occasionally make a mistake. I am legally licensed to give financial advice, but we haven't signed a contract. This is just a live conversation. So, like I said, this is not legal, financial, investment, or tax advice. This is just a great opportunity to have a conversation and hopefully provide you value. So with that being said, I will add that comment add that information in the comment section so you can schedule a call if you'd like. Otherwise, please comment now or anytime during this conversation with questions, topics, or comments regarding retirement planning. I'd be happy to address them. In fact, I'd prefer to address your thoughts rather than just read articles. So with that being said, I don't see any comments yet, so I'm going to jump into the first article I have prepared for today, and it is titled 5 Mistakes to Avoid with Your Investment Portfolio in 2025. It is written by Christine Benz, or not written, it's actually a live video, but I'm just going to go through the transcript so we don't have to try to watch a video together. It's between Christine Benz and Suzanne Dubinsky from Morningstar.com, and the article came out January 9th. I will include it in the comments section now in case you'd like to follow along or watch it at a later date or read it at a later date. Either one. All right, with that, the key takeaways that we're going to cover in this article is investors who feel like they missed out on stocks' phenomenal run should not rush to invest all their extra cash at one time. And part of that I agree with. We should never make decisions today based on what's happened in the past. However, historically speaking, the market has been up about 78% of the time on a year-to-year basis. When I talk about the market, I mean the U.S. market, S&P 500. So If history does repeat itself, no guarantee that it will, but if it does, there's about a 78% chance that the market will be higher 1 year from today than it is right now. So why wait to jump in if you already have the cash available? Now, what she's talking about is if it's probably more advantageous to have a monthly investment plan because then you could take advantage of dollar cost averaging. Either way, the point is the best time to start investing was yesterday. The next best time is today. And the third best time is tomorrow. But why put it off? The next takeaway that she's going to talk about is an easy mistake for investors to make is not globalizing their portfolios. It's important to diversify globally. Anyone who is getting closer to retirement, is time to think about de-risking your portfolio. So I'm actually just going to cover the key takeaways. You can look into the article more if you'd like, rather than reading the transcript to change my mind. So the reason why it's important to globalize your portfolio is because even though the U.S. market has been the hottest market for the last 10 to 15 years, the 10 years before that, from year 2000 2010, the U.S. market was almost flat. So whereas the global market, the international market, wasn't during that 10-year period. So it's important to diversify worldwide because that way you capture the growth of the world, not just the U.S. market, as well as diversify your risk so that even if the U.S. market completely tanks, it doesn't mean the other markets are tanking. So it can level out your growth model and not be so volatile within your portfolio. And you never know what the next hottest country is going to be. The U.S. market might be stagnant the next 10 years or 5 years or 3 years. It doesn't mean the world market is going to be. So let's try to capture those gains. The third takeaway she talks about is anyone who's getting closer to retirement, it is time to think about de-risking your portfolio. I 100% agree, but you have to do it in a way that makes sense for you. Oftentimes we'll see these target date funds that just automatically adjust your equity to bond ratio based on your age. Well, the question I would ask there is, do you have the exact same financial goals and the exact same risk tolerance as everyone else your age? Probably not. So should your investments reflect to be the exact same as everyone else your age? Probably not, right? So it's important to understand that your financial plan should be built on your financial situation and your financial goals, not other people around you and what your age is. It's more about your life situation. And understand that it can actually increase your risk if you don't own enough equities, because there's the two most important, or I guess the three biggest risks in retirement are, first, your health, right? If your health goes to crap, your money's going to get spent quickly, and unfortunately it's really hard to afford really poor health in retirement. But besides that, when it comes to the markets, market volatility is talked about every day, and that's where decreasing your equities to own fixed income bonds or annuities or whatever it might be can be valuable. But we also need to understand that inflation is a guaranteed risk, right? Every year we live, life becomes more expensive, so we have to own some percent of equities, if not a majority of equities, to fight inflation over the long term. So that's something to make sure you understand, and if you don't understand it, make sure you hire someone that does, so that they can build a specific portfolio for you. The next key takeaway is investors should not try to guess where interest rates are going to go. So fixed income or bonds are the historically most commonly used way to balance the volatility of equities or stocks. There is, what she's saying, and I agree with, is we should understand that fixed income, short term especially, can be a nice risk offset or volatility offset to equities, but we should never try to predict what they're going to do. Just like we should never try to predict what the market's going to do, when equities are going to do. Historically speaking, equities have averaged about 10% return a year. Bonds or fixed income have been about 5 to 6, about half. But that's history. It's not the future. And we never know what year it's going to happen. We don't know what politics is going to do. We don't know what the Fed's going to do. We don't know what anyone's going to do. So it's more important to build a portfolio centered around your goals and our beliefs and the structure of the system itself than it is to try to guess what's going to come and what's going to happen in the future. And the last but not least, I talked about this point earlier, but it's really, really important. People should try to avoid getting complacent about inflation. This is by far the number one thing that I feel like I have to, or I talk to people about a lot, is because the news is always blasting you with market volatility. And the S&P 500 did this, the Dow Jones did that, and the world's going to do this, and whatever. What the news doesn't look at is long term how inflation erodes your financial situation. So it's extremely important to understand that in order for you to maintain your lifestyle in retirement, you actually have to increase your assets and increase your income to fight inflation. And the longer you live, the harder that is, and the more it becomes a center of focus. Fortunately, Social Security has natural step ups each year, but annuities do not. And your stock and your equities or your stock portfolio that has to be, you have to understand how you can dynamically increase or decrease that income that you're pulling from it based on how it's performing. So there are 5 mistakes to avoid with your investment portfolio in 2025 according to Christine Benz and Morningstar.com. Again, I'll repeat the key takeaways being: investors who feel like they missed out on stock's phenomenal run should not rush to invest all their extra cash at one time. An easy mistake for investors to make is not globalizing their portfolios. And anyone who is getting close to retirement, it is time to think about de-risking your portfolio. Investors should try not to guess where interest rates are going to go, and people should try to avoid getting complacent about inflation. Any questions, thoughts, comments, or concerns on the 5 risks or 5 mistakes to avoid with your retirement planning? Seeing none, I will move on to another article here, and it is titled, "Is Inflation Really What Ails Stocks and Bonds?" And that is, again, it's a Morningstar article, and I will include it in the comments section in case you would like to follow along or read it at a later date. So this is written by Sarah Hansen, and she says, disentangling the signal from the noise, investors expect sticky or maybe higher inflation, but they also anticipate higher growth. And this was written on January 10th, 2025. She says, and here's the key takeaways. And based on these key takeaways, I may or may not read the whole article, but it might be just worth covering the key takeaways. So, first key takeaway: a series of strong economic reports on inflation and jobs have investors more concerned about inflation in 2025 than they were just a few months ago. Second key takeaway: sticky inflation and a strong economy are reshaping the Federal Reserve outlook for rate cuts. Investors now see the Fed holding rates at a higher level for longer. Third, both stocks and bonds have struggled to adjust the new outlook, with inflation-sensitive stock sectors underperforming and bond yields climbing. And fourth, the key takeaway: investors expect strong economic growth to accompany stubborn inflation in the months ahead, a silver lining for markets over the long term. So, with that being said, does anyone feel passionate about going more in depth on those key takeaways? Seeing none, then I will just basically highlight the point of that being, we cannot predict the future of what the Fed's going to do, so therefore we shouldn't try to guess what inflation's going to do, and we shouldn't try to guess what interest rates are going to do. We just have to plan accordingly with the understanding they will always be changing. All right? And that goes for mortgage rates, that goes for loan rates, that goes for fixed income or bond rates, that goes for how the market's going to react. We have to understand that a lot of this information the big companies have already baked in, so we don't want to overreact, and also try not to predict. So that article is included in the comments if anyone wants to read more in depth. All right, last but not least, I would love to get some questions or comments if anyone has them to address for you personally, but if I don't, I will make this the last article I read today. This article is on Yahoo Finance, and the title is 4 Purchases Keeping the Middle Class from Retiring Early, written by Vance Carriaga on January 11th. I'm going to put that in the comments in case you'd like to follow along or read it at a later date. All right. So, and here's the article. For most people, the dream of retiring early never makes it past the dream stage. On average, Americans target a retirement age of 62, but anticipate they might work until about age 70, according to a recent survey from Empower. Retiring early on a middle-class income is especially challenging and all but impossible for those who don't carefully monitor their spending. Data from the Pew Research Center found that middle-income households had an annual earnings range from about $56,600 to $169,800 as of 2022, depending on where you live. Meanwhile, a smart asset analysis found that if you want to retire by age 55, you need to have at least 7 times your annual income saved up. So, if you earn $70,000 a year, you will need to save up $490,000 or more by age 55. Doing that will take a combination of aggressive retirement savings and frugal living. Unfortunately, some middle income earners have a hard time with the frugal living part. Here are four purchases that often keep middle class Americans from retiring early. And I think this is extremely important for two reasons. First, the society we live in and human nature has always been instant gratification is so much easier than delayed gratification. And the idea of retirement is the definition of delayed gratification. The work you do today, the savings you do today, the planning you do today may or may not impact you greatly for 5, 10, 15, 20, 30, 40 years, but it's just as important, if not more important today because of how compounding of wealth works. All right, so money you save today is more powerful and more valuable for your retirement than money that you save tomorrow and every day thereafter. So it's an inverse relationship of the more you do today, the better off you'll be then later, but the longer you have to wait to actually feel the fruits of your labor. So that's why retirement planning is so challenging for so many people, is that it's the delayed gratification, and more in depth than that, it's all the complexities that come with financial planning, all the options that there are out there. So, coming back to the article, here are the four purchases that often keep middle class Americans from retiring early. First, a costly home. The easiest way to ruin your early retirement plans is to buy more house than you need. As a general rule, your total home value should be no more than 3 to 5 times your total annual household income, according to Fidelity. If you earn $70,000 a year, for example, then you should not spend more than $350,000 on a home. That's tough in a housing market where the median home sales is more than $420,000, according to the latest Federal Reserve data. Even so, you should resist the urge to buy an expensive home if you want to retire early on a middle class income. A big down payment means less cash for your retirement fund. In addition, you'll be hit with a higher monthly mortgage payment along with the higher property taxes, maintenance costs, and heating/cooling bills than you would with a smaller, cheaper home. The second thing ruining your potential ability to retire: brand new cars. 100% agree. This is the worst purchase anyone can make. It's a massive, expensive liability, right? They say the average price of a new car was $49,345 as of December 2024, according to Copilot. That compares to an average of $32,065 for a used car, a difference of more than $17,000. If you buy a new car every 5 years, then you could be spending an additional $70,000 over the course of 2 decades versus buying a used car. That kind of cost difference can greatly hinder your plans to retire early on a middle class salary. Third, excessive subscriptions. A blog on the New Trader U website refers to subscription overload as the silent budget killer. Subscription costs might seem low when you look at them individually, but they add up quickly when you are juggling a bunch of them. You might be paying $100 a month or more on streaming service subscriptions, gym memberships, and similar purchases. That's $1,200 a year, money that could be put into a retirement account where it would grow much bigger thanks to compounding interest and investment gains. Fourth, private schools. Nearly all financial advisors warn against pouring so much money into your kids' education that it hurts your own retirement plans. But many parents still do it. In some cases, middle-class parents send their kids to private elementary and secondary schools and high schools. As of 2021, these schools carried average yearly tuitions of $12,790 and $15,344 respectively, according to Education Data Initiative. You could end up spending more than $200,000 on private school tuition before your child even goes to college. Once they reach college, you might spend an additional $200,000 over 4 years if they attend a private university. You'll have a much easier time retiring early on a middle-class income if you find good public schools and in-state public universities. All right, so those are the four purchases keeping middle class from retiring early. Recap: costly home, brand new cars, excessive subscriptions, and private schools. With that being said, any questions, comments, or concerns on one of the 3 articles that we read today, which first was the 5 mistakes to avoid with your investment portfolio in 2025. Second, inflation. Is inflation really what ails stocks and bonds? And third, 4 purchases keeping the middle class from retiring early. All right, seeing no questions or comments, I will end that today's retirement planning coffee talk by just saying thank you for those who stopped by live or watch at a later date. I genuinely appreciate you and hope I'm bringing you value. In order to bring more people more value, please take the time to share either publicly on your social media or privately via message to your friends. Comment with your questions, thoughts, or requests for future Money Not Math retirement planning coffee talk topics. And at the very least, click the like button so I can hopefully reach more people and provide more value to more people. So with that being said, thank you guys again for your time, and I hope you have a wonderful day. Bye.